Guys, it is Markets with May, and this is take 2 of an episode that we're going to do on the residential REITs. Now, I had a couple of technical snafus, so if you caught the first episode, hopefully the second episode will be even more helpful with less glitchiness to it. Now, I wanted to do the residential REITs as an industry overview because, quite frankly, there's a bunch of tailwinds and then there's a bunch of nonsense that people are saying about the current situation in the banking system. And provided we don't go completely into the deep end economically, the residential REITs are actually looking really good. So I'm going to go through the major S&P residential REITs. And then it's not meant as a full on, it's really meant as an industry overview. So I'll talk to you about the additional research that you may need to do. Some of you might be looking for exactly this type of investment right now. Some of you are more like me. You kind of need to monitor it, watch it. Even if you were to nibble a little bit of a position size now, you'd want to kind of back it off. I would say if you're younger and you're mostly into the go-go names and you've been looking at this volatility thinking it's crazy, if you have an IRA or some sort of portfolio, I've always enjoyed the high dividend yielding stocks because they give you cash and you can play around with that as well as play around with whatever you're putting in from work in your 401k, et cetera. Now, I wanted to show you these 5 companies first and foremost so you can see them. Let me share my screen. And it's always funny. As soon as I hit the record button, I get 1,001 texts. Nobody ever texts me otherwise. But here's the 5 residential REITs that are in the S&P 500. And it just so happens that there are other forms of residential REITs, single family home, manufactured home, et cetera. But these 5 residential REITs are apartment REITs. Okay. Now, I'm only going to do the briefest overview of REITs. There's a lot of information out there, but the highlights and important points of the REITs is that they really by law have to distribute in order to maintain that structure, a dividend. So you will pay taxes on this if you are doing this in a retirement account. Alternatively, as you get older, you kind of like that dividend because when you stop working, it's nice to just have that cash flow coming in one way or the other. Also, a lot of people talk about the REITs as if they're just one thing. They are not. They are divided into pretty much everything under the sun. This is a one way to divide it out, but there's other ways to divide it out as well. So we're doing this sliver residential, which can include a variety of things, and we're doing large cap. Okay. Now, what are the headwinds of specifically residential REITs as to why I'm so intrigued if we can just get past the most recent craziness, if you will? And what's interesting is this right here. Now, there is the National Association of Realtors for the United States. You're not in the United States, you're going to have to learn your own set of economic indicators and what's going on there. But the National Association of Realtors is saying that in order for home pricing affordability to reach pre-COVID times, you're going to need rates to go down to 2.6%. And even I'm not thinking we're going to have a continuous stream of rate increases. I'm not thinking we're going back down to 2.6%. So just realize that is one big tailwind for all of these residential guys. The second thing is that home prices are going to have to fall by a third to get it back to the affordability of yesteryears, or one of these 3 things is going to have to happen: 50% increase in family income in order to make buying affordable or more interesting than renting. Okay, so these 3 things are massive tailwinds to the residential REITs, period, and why I'm intrigued by them, provided the wheels don't fall off of the economy. Okay, so that's just affordability versus renting. And then on the development side, some of you saw the home building tutorial that I did or overview that I did the other day. And I told you that multifamily is really taking it on the chin even more than single family as far as who's paying or what's being built and housing starts. And so the apartment REITs are also benefiting from this because the dynamic, I'm just going to say it. There's people out there that try to show it differently. I said this in the home building. I'm going to say it here again. The inventory is low because we have a 10-year non-build coming out of 2008. And so people that are showing these charts and not, zooming out back to 2008, they're doing a massive disservice and they're a little bit lying. I don't know another way to say it. So a lot of people are showing this chart from 2008 to current. You don't trust those people. They haven't been in the marketplace long enough to be doing anything as far as describing what's going on in the industry. This is the truth of what's going on in housing. And yes, there is regionality to it. And we will talk about that in a second. The other thing I want to show you clear as day comes from CPI. And if we look at CPI, the major component that is increasing in CPI is shelter. That's a huge component that remains. And that is being strangely impacted negatively by an increase in rates. So this is why when everybody's so up on their high horse about the only way to get rid of inflation is to raise rates, realize that shelter, which is increasingly becoming the largest uncontrolled portion of inflation, actually goes the opposite way. And the beneficiary of this desire that people have to say that what we need to do is increase rates to protect inflation, the benefit of that, the net beneficiaries of that are the residential REITs for the reasons that I just spoke about earlier. So as a result, provided the wheels don't completely fall off of this economy, the residential REITs are just in a fantastic shape with lots of potential tailwinds. Now, let's actually go through a couple of other nuances before we get into the names themselves. This is what we saw as relates to the U.S. migration pattern. We saw a lot of folks moving to the blue states here, which happen to be the red states politically, but we'll call that for another day. That's not relevant. I've put the top 5 up at top as far as just sheer raw where they rank as far as population growth goes. But then when you look at the raw number, you get a slightly different picture. You got a lot of people moving to Florida, Texas, North Carolina. Let me just tell you, that is a multi-year situation, and they've had low inventory this entire time. So just realize that those, what we call the Sunbelt states, have been in a state of low inventory for an excessive period of time. Now, a lot of folks are going to say, hey, May, you can't, they'll say any number of things about building cost, et cetera. The fact is a lot of raw material costs have gone down. And because we're no longer building at the same rate, because rates have gotten so high, again, the earlier slide I showed, you don't have inventory coming in. And the lower prices and some of these other things are helping these guys to even mitigate some costs there on the fixer up. Additionally, if you keep having this dynamic go with shelter increasing 8%, you've got all these residential REITs basically, instead of needing to advertise to get new tenants, you're just re-upping the lease and charging you more rent. Okay. So lots of tailwinds if things don't fall off. Let me keep going with some of the just macro part before we get into individual stuff. This is another way to show the housing demand supply gap. This comes from Equity Residential, which is someone I'm going to talk about here. And you can see since 2000 and the post 2008 work through period, we've had demand higher than supply all the way through. It's not getting any better. Okay. And with that, let me actually start going into it a bit. The first company that I'm going to talk about is Avalon Bay. And we're going through these very briefly and then going to just take some Q&A. Avalon Bay is usually not there. I would say that they have a little bit of a tendency to be near an urban center, but not in an urban center. So if you're in New York and you were interested in this, the greater New York region, it won't be in New York City, Avalon Bay. It'll be like across the water in Jersey. There might be some properties in Suffolk County, et cetera, and then so on and so forth. But they've got a 95% occupancy. They're not giving concessions any longer. They, across the entire portfolio, year over year, increased rent by 4.2%. And funds from operations, not EPS, is what we're looking at, grew 13% last quarter. Now, let me just take a half a beat on funds from operation. For those of you that aren't familiar with that term, funds from operation is going to take into consideration your depreciation amortization. Now, when you're looking at funds from operation, most REITs that are larger in size will give you core, adjusted, and sometimes they'll even give you something else. Okay. But what you want to really understand is what is the nature of funds from operation in the way they're trying to report it. If there's a lot of M&A activity, if they got rid of a lot of properties and then bought a lot of properties, when they're telling you core funds from operation, they're telling you basically the existing portfolio. When they tell you adjusted, they're doing oftentimes something else. In both cases, it's fair and square because all you're trying to do to figure out what's going on is what are they making last year versus this year. So it's going to be funds from operation. But if you're researching things other than the ones I'm presenting, look carefully at the numbers, please, please, please. But we're still talking about 13% growth in funds from operations, which you will use instead of EPS to understand the earnings power of these companies, if for no other reason than these things are throwing off dividend at you, and that 13% is telling you whether or not they'll be able to do it. Okay, so that's what we're looking at. Their strategy is to continue to dispose of properties that they know are not as exciting because there's still a lot of money to be made. Other people are definitely buying it. They are focusing in, as you can see in all the little green dots, they're focusing on the Sun Belt and then growth areas. And I'll get to that, Israel. Great question. I see it in the comments. But they are focusing in the high growth Sun Belt areas, which, like I showed you on that earlier map, are still really experiencing shortage and increase in population. They are moving away from the coastal markets that got all kinds of extra stuff going on. And then you can see it's kind of interesting, but the ski belt is also doing pretty well right now as people have chosen to continue to live in those areas. They're just really desirable places to go. So that's Avalon Bay, but it's going to be a little bit more, I want to say suburban, but still usually very close and within a drivable distance to an urban center. So that's Avalon Bay. This equity residential, they're in the heart of urban. So you're going to get downtown Manhattan, the nice parts of Brooklyn, in New York. If you're in Seattle, San Francisco, LA, it's going to be like dead in the heart of fun world, essentially, in all these places. And you can kind of see all of these REITs will give you the map of where their properties are, as well as once you go in the 10K, they'll even give you the address so you can visit every darn one of them if that's the way that you do due diligence. I certainly recommend that you at least visit one of the properties if you can, and you're not, watching me from one of the states that's not got these big property developers in it. Nonetheless, look at the occupancy rate. We're talking about 96% occupancy. That's very high. That tells you that in the areas that they're in, there's not a lot of inventory. Okay. And it's just re-highlighting all this other stuff that I said earlier in the video. 9.5% same story sales NOI. That's a combination of being able to keep people in the apartment and not necessarily have to paint it, renovate it, or otherwise, and then increasing rent on them. So you can look at same store NOI that way. But if you dig through the 10K, each and every one of them usually tells you how much they're raising rent by every year. And that's always just interesting macro to know. FFO for them is about 14%. So they're growing at about 14%. And again, that's coming from a host of tailwinds that they've got, provided the wheels don't fall off this economy. Their strategy, though, is a little bit different from Avalon Bay. Because they're in those urban markets, they're essentially going to keep working on renewing and upgrading the properties to make them extremely attractive relative to the individual landlord that's trying to, get their property out. They're going to monitor the health of the economy because they know that they're attached to it. They produce some of the best macroeconomics research, by the way. And then they're really not buying unless it's highly opportunistic. Like they're going to have, because right now, the word that's the buzz, the way that residential, the property folks look at it is called cap rate, but cap rates are lower, fair and square, because interest rates are higher. So they're really going to have to see great returns. Otherwise, they're making great money off of existing tenants in place that, provided inflation keeps bringing up the cost of labor, and it provided these folks still have enough job growth, they just as soon charge you more rent and have you stay there and not have to renovate the place for you. Now, one of the things they said at Equity Residential, which is true, but particularly true in the urban markets, that said, it's just basically permeating through, is that the average age of renter is 32 years of age. I want to give you guys a sense for that. That has not always been the case. So absolutely, one of the other things that is benefiting the residential real estate market is that people aren't buying because they're not getting married. I don't know another way to say it. And so there was a period, call it 20 years ago, where the residential real estate market did fantastic because people were getting divorced. Now it's just a fact that people aren't getting married. It's a kind of an intriguing thing. Nonetheless, that's equity residential, mostly urban, and benefiting from a number of things, realizing though that they differ from the other because of the nature of it. Avalon Bay is going to have a slightly different, more family oriented resident than equity will. Okay, moving on to the next large cap REIT in residential is Essex. Now, Essex is my least favorite of the group, and that's partially because the California market always freaks me out a little bit. There's a lot of extra rules in California. Currently, Essex has benefited from the fact that they've gotten looser on this eviction moratoria situation that's come out of COVID. So this whole free rent, you get to sit there, which is wonderful from a social perspective, but terrible from a real estate landlord perspective. That's what always bothers me about the California market. Nonetheless, because they've been coming out of that, because Essex does have a slightly higher income type of renter, that's a little bit less for them, but it's not nothing for them. And it's always a particular concern for me when you've got a lot of market uncertainty going on. But yeah, 100% Hadouken, thank you for posting that. Definitely more on the West Coast, definitely very leveraged to tech, although in every call they try to pretend like they're not. We all can see it clear as day. That said, if you've been working for Microsoft for a long time, you probably can go many months. I mean, I don't want to make assumptions about anybody's situation, but you probably have a nice little cushion for which to find another job or whatever it might be. So that's the one thing with Essex that might be a little bit of a nuance for me. Those of you that are on the West Coast that can see these properties and due diligence a little bit better, Essex makes money. I don't know another way to say it. 16% core FFO is very high, given that this is one of the only industries where I saw very good revenue growth and flowing all the way through the bottom line, just because, like I said, the part of inflation that does not benefit from raising rates, but are the part of inflation that just keeps going up is rent and shelter, and raising rates doesn't do anything but help these guys out. Okay, keep going on here. MidAmerica probably is my favorite pick because it's the one I understand best as a human being. Okay, now I live in New York City, you guys know that, but MidAmerica is more. They're not trying to be the fanciest apartment that you rent. They're trying to be the apartment that you rent, and they're not the low end. They're like smack in the middle. They want to be a nice place with really good management that's affordable. So you're not going to get the highest end fixtures or the craziest technology going on in these MidAmerica apartment REITs. And as a result, I just like them for that reason, because given the reason that I think this particular industry has legs, which is we keep raising interest rates thinking that's somehow going to lower shelter cost. It will not. Again, do you know what I'm saying? MidAmerica is probably the most poised to benefit because home affordability, some of the things that would have taken these people out into buying, there's no inventory to buy it, et cetera, et cetera, et cetera. Again, also, I love the fact that they're Sunbelt focused, because I do have a harder time with the volatility you get from urban centers and the volatility you get on the West Coast and in the Northeast, Boston, New York, et cetera. So realize that there's a little bit more stability with something like MidAmerica. And they also benefit from those they benefit a little bit more easily from the other dynamics that are happening in the construction market, which is some of the real estate folks, the big real estate developers that are now having either rates increase on them and they just want to drop the inventory and get it rented. MidAmerica is benefiting from that too, because those are in the sweet spots of where they rent. So that's a really wonderful thing. Have a look at them if that's more your cup of tea. And definitely do on-site visits, but you can see like the numbers are good for them. And you'll want to go through balance sheet, but I will tell you that the balance sheets look good for all these guys, but you should never skip due diligence. And then finally, UDR is kind of a little bit more luxury, a little bit more urban, and you can kind of see they're smack down the middle. also a great company to look at. They do have exposure to DC and San Fran a little bit more intensely. And so that's, DC has its own special mess going on right now, and still doing great. 2% same store growth, 14% NOI, 96% occupancy. Nothing wrong here. I haven't had a chance to view any of their properties. All the other ones, oddly enough, I've been in those buildings before to take a look. So I'm actually going to hit the pause button right there on the share. And hopefully that was helpful. I think personally, let me take some of these questions that came in, because I think Israel's question is probably the one that everybody cares about. You had a question earlier about the housing market in general. Okay, look, the housing market in general is a tough call, but the rental market is great. I'm not going to even pretend, especially if you're in the demographic areas that exist that are really strong. So the housing market is reflecting the fact that the cap rate and relative to the risk of renting that place out is what it is. And so housing prices, home buying, that's not my cup of tea to even make a claim on. Single family's tough. Your cap rates have shrunk to about 4% versus in 2008 or the period after 2008, you'd have a cap rate around 10%, and that would be how you'd assess value. That shrinkage is intense. Now, also, the other thing that kind of scares me a little bit right this minute is we've got so much uncertainty and the amount of capital you're deploying. I think that if you're a young person trying to buy a house, I could see how that could be very scary right this minute with all that uncertainty. But the rental market's a little more straightforward, because as long as we keep at this and the wheels don't fall off, meaning we don't start to see defaults like crazy, meaning that we don't have a big developer that defaults and sells off property for something that's dirt cheap, like happened in 2008, where properties that were used to be $200 a square foot went straight down to $30 a square foot. As long as that doesn't happen, then rent is still going to be rent. And these guys are not extending themselves. They're not buying crazy stuff right this minute. If anything, most of them are not buying, because what they're really doing is rolling off of the concessions they gave at COVID. Most of them had huge capital buffers to be able to eat those concessions without blinking. So, two different animals. Okay. So hopefully that explains that and is helpful. Where do I think, good question. Where do I think the best investments are right now? Right this second, until we get better clarity with what's going to happen with all of the uncertainty. Because the macro uncertainty is higher than I've seen it. And I thought I would say, I've literally been saying that for 2 years, and I thought it would have already alleviated. It has not. We've got international macro that's coming into play here. We've got what clearly is an unspoken trade war with China right now. And in particular with real estate, that always is a bummer, because China does buy up a whole lot of real estate everywhere on this earth. That is what it is. You've got, as a result, that's affecting our imports in a big way. So it's very hard to unwrap that. And then you've got the systemic issue that's starting to happen within the bank. Now, I know everybody's really sensitive to calling it a banking crisis, but it does cut off the capital markets, meaning it's not as easy to get a loan as it used to be. And then you've got a bunch of people that feel strongly we need to raise rates in order to impact inflation. Then you got a lot of people that feel differently. So all of this uncertainty makes it very hard to figure out where to go. Now, I did finish finally my 80% listening to the S&P 500, and it came out more or less the same as it did the previous quarter as far as earnings deterioration. Now, I'm pretty sure going into this next quarter, that's going to change. And that's going to change because a lot of the companies are probably going to be even more cautious going into the back part of the year, and that's going to put pressure on folks that are farther down on the supply chain. I have mentioned before that the PPI numbers came in negative, which are the producer price index and some of the purchase manager stuff has come in negative. And that's despite the fact that those are leading indicators, and all your inflation folks are talking about what is usually a lagging indicator. CPI is lagging relative to the producer price index. So given that we've had 3 months of PPI negative, but everybody is so sure we're having inflation, it's a tough call. Again, I like these residential REITs because rates have to go down to 2.6%, incomes have to go up by 50%, or, what have you, in order for these guys to have an actual problem. So there's plenty of buffer for these guys to still do just fine. But best investment's always tough. The best investment is when everybody thinks one thing's going to happen, you're truly contrarian and just see it differently. So that's why I like doing these tutorials and overviews, because I don't, so much of this market has gotten hyper reactive, and that's fun and that's exciting. But then there's a bunch of all of us that have a portion of our income, and rightfully so, because we're not 20, in stuff that's stable, that doesn't make it impossible for us to sleep at night, and then we know that's going to do okay. And so that's what these tutorials are kind of dedicated for, is just getting you in front of it on the off chance that you've got a lot of people that are a little bit too intense, just deciding to sell everything that has a concept of mortgage associated with it. That'll create an opportunity in all of the REITs that will be short-term and fortunate, but very exciting for people that just have enough cash on hand to find opportunities that are like that. Let me see what else has come in here. These are great questions. I really do appreciate the questions, guys, because I don't, yeah, this is a true thing, Israel. I want to acknowledge this. These are great questions, but yeah, that's part of California too. California's got its own special weirdness in real estate that I can't possibly appreciate. And so California, that's why I slightly better understand the southern states, being from that area, having grown up in that area. My folks were in real estate for some time. My dad is a GC down there. So I understand the southern states a lot better than I understand the coast. And I understand being in New York for so long, I understand New York really well, but I don't understand you guys in California. I'm just going to admit it. You guys think very differently than we do. You're so funny, Israel. All right. Really appreciate you, Hadouken, for posting all this stuff. I love that you guys are interactive, and I'll end it there at 27 minutes. If you've got ideas for other things that you want to see, definitely stick them in the comments. And don't forget to follow me if you want to support me. I'm actually trying out this membership thing because I'm trying to see if I can learn to press all the buttons correctly. So you can take a look at that. I don't know if that button's showing up or not. And then there's YouTube, Twitter. But I appreciate you guys all for coming. Happy Sunday and good luck on your trading week. Bye, guys.